Your Roth IRA, the account that you've been told is the holy grail of retirement planning, could actually be costing you tens of thousands of dollars in unnecessary taxes. As someone who's run a retirement planning firm and a tax preparation firm for years, I can tell you the countless times where I've seen retirees nearly fall into this Roth IRA trap. They spend decades accumulating this tax-free Roth balance through contributions or through doing Roth conversions to ultimately leave this money untouched and continue to overpay in taxes. They're so focused on accumulating Roth dollars that they forget that the entire point is to spend this money strategically to minimize taxes over a lifetime. And so the retirees that can break free from this trap and avoid this mistake, they save money, but they don't just save a little bit in taxes, they save massive amounts. And I'm talking about hundreds of thousands of dollars over the course of their lifetime. And they do this simply by understanding how and when they should be spending their Roth dollars. And that's exactly what we're going to cover in today's video. So today's video is not about accumulating more Roth money, but exactly how and when we should spend the Roth dollars we already have. And through each of these situations, right, I'm going to explain exactly what it is we're looking at, and then I'm going to quantify the benefit of using the Roth IRA dollars in this strategy. So let's dive in. So situation number one has to do with claiming the premium tax credit. Now, this is relevant to our plan if we are under age 65 and retiring early, where we're not eligible to then jump onto Medicare. Now, if you're watching and you're over 65, stick around because the rest of the video is going to be very applicable to you. However, in this case, for early retirees, you're going to want to pay attention to this. Now, the cost of your health insurance premiums on the health insurance marketplace will be heavily dictated by the amount of premium tax credit you qualify for or don't qualify for. And the credit is calculated with the following formula. They're going to take the second lowest cost silver plan available to you, right? There's multiple options. You can pick bronze plans, silver plans, gold plans, or platinum plans. Right? And then they're just going to subtract, right, from the lowest cost silver plan amount available to you, what your expected premium contribution should be. And the difference is going to be your premium tax credit. So to quantify this for you and just to share with you the numbers here on how they actually back into what your expected premium contribution amount is going to be, it's all going to be based on a percentage, right? What percentage your income is actually over the federal poverty line. So for a household of one, the federal poverty line is $15,000 a year. For a household of two, it's about $20,000 a year. Now, this is going to be your modified adjusted gross income, which is the very top line of your tax return. Plus, they're going to add back any non-taxable income like non-taxable Social Security, for example, or non-taxable interest, and a handful of other things as well. But for the examples today, we're just going to look at straight IRA withdrawals. Now, how much premium tax credit you'll qualify for will be dependent on where you fall on the spectrum in terms of your income in relation to that 100% federal poverty line number. So as you hit 400% of the federal poverty line numbers, so that's $60,000 for a household of one, about $81,000 for a household of two, we will have the highest amount of expected premium contribution amount, which would then potentially eliminate us from receiving any premium tax credit at all. So to share with you what those amounts are, right? If we keep our income, our modified adjusted gross income, under 150% of the federal poverty line number, we have a 0% expected premium contribution, right? $0. That means free or potentially free, in this case, health insurance, again, depending on the plan we pick. And if our income's above 150 or less than 200,000, we're going to be in that 2% of our income as expected contributions, right? Then as it goes up, it's 4%, then 6%, and ultimately reaches a max contribution number of 8.5% of our income will be then expected to be contributed to health insurance premiums. And to quantify this and show you exactly what this looks like, we're going to go through two situations. One, if we're spending $10,000 a month. Another, if we're spending $20,000 a month. Now, let's just say we are withdrawing 100% from our traditional IRA. We're spending $10,000 a month. That's $120,000 a year, which means our modified adjusted gross income in this case, if this is our only source of income, is $120,000. As a percentage of the federal poverty line for a household of two, in this case, we're at 587%, which means we're at that highest tier, right? We're going to be expected to contribute 8.5% of our modified adjusted gross income towards premiums. which means that our expected contribution is $10,200 for the year. Now, to make this simple, right, let's just say we're going to go ahead and purchase that second lowest cost silver plan, right, just to make the example easy. And that second lowest cost silver plan costs $20,000 a year, right? Our expected contribution amount is $10,200, which would mean we'd get roughly a $10,000 premium tax credit, and our out-of-pocket would just be $10,200, right, if we're going to buy that specific plan. However, if we wanted to be a little bit more intentional about our withdrawal strategy and want to get the price of health insurance premiums down, right, we want to split then our withdrawals from our traditional IRA and our Roth IRA. So in this case, we may want to withdraw about $30,000 from the traditional IRA and then about $90,000 from the Roth IRA. That's going to keep our modified adjusted gross income at around $30,000, which is going to be, for a household of two, 150% of the federal poverty line, making our expected contribution percentage 0%, and therefore our expected contribution $0. So if we looked at the exact same policy, right, the same exact insurance plan, where it's the second lowest cost silver plan, and it's $20,000 a year just for the hypothetical example, right, our expected contribution into that would be $0, which means we're getting a $20,000 health plan for free. Or even if we're just comparing it to the pulling money out of 100% from the traditional IRA, where we'd only be spending about $10,000 for that policy, right, we're saving $10,000 a year in premiums still. So if you're, 5 years out from Medicare, that's $50,000 in tax savings, or I guess in premium savings in this case, where that's money that stays in your pocket. Now, if you're concerned about, well, I'm going to have higher withdrawals later, I'm worried about IRMAA, I would probably, again, depending on the situation, really want to evaluate, well, what does it look like to save $10,000 a year in premium today? And then if I aggressively hit some Roth conversions after 65, even if I paid Medicare IRMAA for a couple years, your first Medicare IRMAA bracket might only put you in, an additional $2,000 in Medicare IRMAA, right? It might not be that bad, right? And it might be a very worthwhile trade-off to have a lot of premium tax credit today and maybe pay a small amount of IRMAA in the future, if that's even an issue, right? There's a lot of times where we can actually get away with doing pretty aggressive Roth conversions, still staying within IRMAA, manageable IRMAA thresholds, and really just walking away with a lot of tax savings here. So I'm going to do a much more in-depth video about the health insurance marketplace and maximizing this premium tax credit. So if that's something of interest to you, if you're planning on retiring before 65, definitely subscribe and be the first one to watch that in-depth health insurance marketplace video. But just to further drive home the value of this strategy, right? If we were to double the income, say we're going to spend $240,000 a year, so $20,000 a month, right? If we're looking at the same numbers here, we might be at a $20,000 expected premium contribution because of where our income is. And in that case, if we don't get any, right, premium tax credit, if our second lowest cost silver plan, and that's the policy we're going to buy, is $20,000, right, we get no tax benefit. It means we're going to spend $20,000 a year on those premiums, and, right, there's nothing we can do about it unless we want to get intentional with our withdrawal strategy. So following just that same example, if we took the majority of that income from the Roth IRA, if we look at the other situation, we're going to take the same $30,000 from the pre-tax IRA, which, by the way, will get net out with the standard deductions. So you're actually going to pay zero income tax for the year. But then we're going to take about $210,000 from the Roth IRA, our modified adjusted gross income, because Roth withdrawals do not count towards it, would only be $30,000 a year. We are at 150% of the federal poverty line for a household of two. Expected contribution is zero. The amount of premiums we pay on the second lowest cost silver plan is then zero, right? So that's $20,000 a year in tax savings. Again, this might be a really aggressive example, right, just to illustrate the point here. But maybe we decide, you know what, we're going to manage our income so that we spend $10,000 a year on health insurance, and we're going to get a $10,000 premium tax credit, and we're happy with that trade-off, right? So you could always find somewhere in the middle, but I want to share this illustration and quantify these numbers for you so that you could see on the extreme ends how much tax savings there is to be had if we are aggressive enough with our planning. But on to situation number 2, which is going to just be avoiding higher tax brackets. Now, I know this seems like a really straightforward and potentially somewhat obvious situation, right? If we don't want to pay more in taxes, we'd pull from the account that's tax-free. But you'd be surprised how often we would run into this, because the common rule of thumb, or the common best practice, right, in air quotes, is that you're going to spend your brokerage account money first, then all of the traditional IRA money, and then all the Roth IRA money. And very often that rule of thumb or that best practice kind of gets lost on us, where we don't think about the actual taxes on a year-to-year basis. And we don't ever realize that we're at the point where we have enough Roth money saved where we could start splitting our withdrawals between pre-tax and Roth to manage our tax brackets, right? It's very common where that Roth IRA, because it's been so coveted, you worked so hard, you've paid so much in taxes on these conversions to get money into this account, we're afraid to touch it. We don't want to touch it. Ultimately, to our detriment, because we're going to then overpay in taxes, continuing to draw from the traditional IRA. So keep in mind that our tax system here is a marginal tax system, which means only the next dollar at the next bracket will be taxed at that rate. So let's look at a couple of situations here where this would make sense. Now, we're going to spend $15,000 a month, and we're going to be a married filing jointly household. That's $180,000 a year. We take all that from the traditional IRA, our adjusted gross income is going to be $180,000. Once we back out our standard deduction, we're at $150,000 of taxable income. That, at the married filing joint brackets, puts us at the 22% tax bracket, and we will be paying $22,828. If we were to just be a little bit more intentional with our withdrawal strategy and say, all right, I'm going to actually only spend $125,000 from the traditional IRA and then $55,000 from the Roth IRA, we're going to still have the same $180,000 a year total spend, but our adjusted gross income is going to be $125,000 instead of $180,000. Then our taxable income will only be $95,000. That keeps us at the very top of the 12% marginal income tax bracket, and the taxes due on that amount of income is only about $11,000, which, pretty amazing, cuts your tax bill in half, right? You're saving $11,000 a year. If you just run that out for 10 years, right, you're saving well over $100,000. If you look at this for a 20-year retirement time period, right, you're saving over $200,000 in taxes by just avoiding that big step into the next bracket, because we do have these big jumps between the 12 and 22% brackets, or between the 24 and 32% tax brackets. If we, again, avoid these big jumps, we can save a lot of dollars in taxes. And so it's not just the ordinary income tax brackets we want to think about, right? We talked a little bit about IRMAA before, but if we want to think about IRMAA in this case as well, it can be very, very valuable for us, because with the Medicare IRMAA brackets, if we go $1 over the next bracket, right, we're stuck paying that Medicare IRMAA for the entire year. It's a cliff, and it's a cliff that a lot of us want to avoid. So to quantify this for you and to share with you the numbers of where this might make sense is, let's say we are still spending $15,000 a month. Let's say we're doing that at the single brackets in this case, just to give you a different example. In this case, that means $180,000 a year is coming out of our traditional IRA if we're not paying attention to our withdrawal strategy and we're just following that best practice or that rule of thumb. Nothing's going to come out of the Roth IRA. That means modified adjusted gross income. Now, modified adjusted gross income is what's used for Medicare IRMAA. So they're going to just take your AGI plus non-taxable interest. So your modified AGI in this case, or again, because we're going to exclude or ignore any kind of non-qualified account, we're going to assume we have no non-qualified money, is $188,000 a year. That puts us in the fourth Medicare IRMAA bracket. You're still going to be at the 24% marginal income tax bracket. And then your total IRMAA, right, this is the amount that gets added, right, to that standard $185 a month for your Part B premiums and Part D premiums, is going to be about $4,200 per year. All right, so you're not going to get anything extra for the extra $4,000 you're giving the government. You're just going to pay more. So if we have enough money saved in the Roth IRA and we're able to split our withdrawals, this is what it could look like. We're going to have $105,000 from the traditional IRA. We're then going to take $75,000 from the Roth IRA to still get us to $180,000 a year in total income. But our modified adjusted gross income, the number used to then calculate the Medicare IRMAA, will only be $105,000, which at the single rates keeps us from having to pay any Medicare IRMAA adjustment. And therefore, right, that IRMAA is going to be $0. Now, for a good chunk of this income, we're still going to be at that, 24% bracket. However, right, this just gives the show, right, by being intentional, we can pull that $4,000 a year expense, right, off your income statement. And so maybe this is, again, more more aggressive than we want to be, right? Maybe there's not as much merit for trying to spend a lot of Roth money just to avoid four Medicare brackets. But let's say we do manage it somewhat and just drop a tier, right? Drop down one bracket or drop down two brackets. The point is that we could always find somewhere in the middle that makes a lot of sense for our short-term and long-term goals. It's not one size fits all. I just want to quantify the larger extremes here so that you can see the benefit of this planning. But let's wrap up and let's talk about the third situation where this might make a lot of sense, where we're going to want to spend a lot of Roth IRA money during our lifetime. And that's going to be actually how we want to manage our estate plan. And there's three areas here that we want to think about. If we want to gift money after we pass away, if we want to gift money during our lifetime, or if the beneficiaries that are going to inherit this money have a substantially lower tax bracket than we do. So for example, if we're going to leave our assets to charity after we pass away, in that case, the nonprofit entity doesn't pay any tax. And so there's no instance where I'm going to want to pay the tax voluntarily during my lifetime and leave Roth IRA or non-qualified money behind, right, for a nonprofit entity to not pay tax on anyway. So I'm going to want all of the pre-tax money that I could possibly leave, right, to be left to that nonprofit so that nobody pays tax on that, right? So think about what an amazing deal it is. You put money into this account, you got a tax deduction for it. It got to grow tax deferred. And then ultimately when it gets withdrawn by the nonprofit, they don't pay tax, which means no money goes to taxes in that situation. Definitely an amazing deal. Now, if you are gifting during your lifetime, and I'm going to quantify all this in just a moment for you, but let's say we're gifting during our lifetime and we are going to give, or we have the ability to give $108,000 per year per person, right, to a nonprofit entity directly from our IRA. Now, that traditional IRA distribution will not hit the tax return. It keeps your modified adjusted gross income low, which again is good just for your regular tax brackets, but even better for the Medicare IRMAA calculation. So in that case, I might want to spend more of my Roth IRA money knowing that I'm going to donate this pre-tax money during my lifetime and save a lot in taxes while doing it. And then lastly, if our beneficiaries just have a lower tax bracket than we do, right, they can inherit this pre-tax IRA money, which means that we're going to spend the Roth money during our lifetime because ultimately, if we think about the taxes across both generations, they would pay less tax than we would. So again, to quantify this, let's just say we have $1 million of traditional IRA money that we're spending, right? And this is not in 1 year, right? This is over time. Let's look at the tax if we were to spend this money versus donate this money versus leave it as an inheritance to someone who will pay tax on it. So we have $1 million in cumulative IRA withdrawals, again, not all in 1 year. And we're going to say we're going to just average out a 15% effective tax rate on this $1 million. We're going to pay $150,000 in taxes on this money, right? At 15% effective rate, not too bad. However, again, if we think about that estate planning situation where our intent is to leave all of our assets to charity, right, or at least a portion of the money to charity, in that case, if we donate this $1 million in IRA money to a nonprofit entity, they're going to pay $0 in taxes when they inherit it after you pass away. Or if you want to donate it during your lifetime through qualified charitable distributions, right? And we're going to earmark that $100,000 a year over a 10-year period, for example. In that case, again, $0 in taxes. That, again, saves $150,000 from going to Uncle Sam, which means it's $150,000 more that would go to the entity of your choice, or that can, again, be kept for yourself. And then lastly, if we just looked at leaving this money to beneficiaries that have a lower tax bracket than you, let's just say we're going to leave this money to grandchildren, right? Who are going to be very early on in their life, potentially not earning as much. In that case, if they have a 7.5% effective tax rate, right, they would only pay $75,000 versus your $150,000, which again leaves you with an extra $75,000 to be split essentially between you and your beneficiaries. And this is really important because this, along with any other strategy that we're talking about, ultimately comes down to the following ultimatum, right? Someone's going to spend this money. Ideally, it's you. But if it's not you, it will be your beneficiaries. And if it's not your beneficiaries, it will be the government. And depending on how intentional we are with our planning, will dictate, right, how much each of those three entities gets to spend, right? And ultimately, how much then gets sent to taxes. So really important to be as thorough as we need to be with this tax planning, and do not just let the allure of hanging on to this Roth balance because we work so hard to accumulate it prevent us from actually using it for what it's meant to be used for, which is minimizing taxes over a lifetime by spending it. So if you enjoyed this video, please subscribe for more videos just like this. If you are looking to see how me and my firm help clients with this on a daily basis, take a look at the link in our bio. Thanks for watching.